Ben has saddled himself with a challenge. Around $100 a month for 10 years, bought automatically, no matter what. A perfectly normal savings plan. Except here, everything flows into a single asset, Bitcoin. His goal? 100,000. By the end, he would have paid in roughly 1/8 of that. The rest would have to come from price gains. We ran the numbers on what lies ahead for him. Not with opinions, but with 15 years of real price data, and with the questions that came up along the way, because those revealed more than any chart. Before any chart shows up, the most important thing, what's happening here is concentration risk, by design. All the eggs in one basket, no diversification, no safety net. That's exactly why we're following it. Because this experiment shows what concentration risk does to someone's savings. Spreading money across asset classes, countries, and industries smooths out the swings. Economists have been showing that since the 50s, and the work later won a Nobel Prize. Putting everything into one thing gets you both extremes, the best outcomes and the worst. You're about to see both. This is not a recommendation. It's a record of what happens. For this bet, Ben built himself a cockpit, a dashboard where he can adjust every dial and instantly see what it changes. To turn $100 a month into $100,000 after 10 years, you need just over 34% return. Per year, 10 years straight. The price would have to multiply almost 20-fold. All Bitcoin combined would then be worth about as much as all the gold in the world today. That's not a forecast, it's a bet. If the price gets there, the bet is won. If not, it's lost. Ben's first question for the cockpit was the obvious one. What if at some point I move up to $200 a month? The cockpit's answer. The odds of hitting the goal rise from 37 to 49%. More money helps. But even then, it stays roughly a coin flip bet. Ben's next question sounds trivial and isn't. What do these odds actually mean? The answer? The cockpit builds 3,000 possible scenarios from real monthly Bitcoin moves from 2013 onward in half-year blocks so that crash streaks stay together. Then it lines them all up by size. The typical case lands at about half the goal. If things go well, you end up with several times the goal. If they go badly, with only a fraction of it. And now the part that tends to get lost when people rave about savings plans. In 23 out of 100 of these scenarios, you end up with less than you ever put in. Almost 1 in 4. And that's not a math game. The Bank for International Settlements ran the numbers in late 2022. In the middle of the crash, 3 out of 4 retail Bitcoin buyers worldwide were underwater, including the ones with a savings plan. That's also why nobody honestly boils a distribution like this down to an average. A few extreme cases drag it up to 24 times the typical case. Then came Ben's objection, and it's a strong one. Bitcoin fans keep saying it's worth more and more, but at the same time, returns are falling? How does that fit together? It fits, and it has to. Across the whole history, the typical 4-year return sits at 88% per year. But that number is a rearview mirror, and it's dropping measurably. Peak returns have been cut in half roughly every 4 years, though that pattern rests on just 3 market cycles, so it's uncertain. A single back-of-the-envelope calculation shows why it has to keep going that way. If that 88% held for another 10 years, all Bitcoin combined would be worth more than the estimated wealth of the entire world. There is not enough money in the world, so the price can keep rising and returns still fall. What sounds like a contradiction is simply math. Most recently, the 4-year return stood at 29%. The bet needs 34, so it's also betting against this trend. The question Ben kept coming back to for 3 days in different forms was this. What if I just wait until Bitcoin is cheaper? Why buy at a high price? We ran the timing ideas through the cockpit. Best weekday, best day of the month, buying after dips, weekly instead of monthly. The result? None of them reliably beats the simple monthly auto buy. Patterns do show up. They just don't survive testing on fresh data. Search long enough and any data set will hand you a coincidence that looks like a secret. And then there is this one day, April 8th, 2021, the worst lump sum day in Bitcoin's history so far. Someone who put everything in on that day ended up at 7% a year 4 years later. Someone who started a savings plan on the very same day above 39% a year. Same start date, wildly different outcome, because the savings plan kept buying cheap all the way through the crash that followed. That's dollar cost averaging, the thing everyone talks about. Here it is in action. Across all 131 starting months from 2011 to 2022, not a single savings plan ended in a loss after 4 years. One honest caveat, that was Bitcoin's rise. What's proven is not that a savings plan always wins. What's proven is that the entry point matters much less. Why now of all times? Ben has a theory about that, recorded in the summer of 2026. He thinks the price is near a low right now, so the odds of building from here are better. Whether he's right, nobody knows. That's his bet, not this video's forecast. His second point is simpler. If the price drops further, the auto buy picks up the low at cheaper prices automatically. That's all the protection there is, and Ben doesn't claim more. His follow-up question then produced the strongest finding of the whole calculation. What if I simply pay in more later? The answer, what matters more than the amount is when the money goes in. Take the same total and spread it differently across the years. More in early and less later, or the other way around, and one version ends up almost twice as high as the other. Early money works longer and catches the higher returns of the early years. The risk of loss barely changes. And what if Ben permanently raises the monthly amount, 200 or 400 instead of 100? That lifts the odds but does not lower the risk of loss. Even then, around 22 out of 100 scenarios end below what was paid in. To close, 2 moments from the edge of this experiment. They say more about money than any chart could. The first, Ben shows Mia the cockpit. She sees the odds that were on the screen at the time, 61%, and she asks, "You're assuming 30% returns here, but doesn't your own chart show they're falling?" She was right. The cockpit had ignored its own finding. After the correction, the odds dropped to 41 to 43%. Asking instead of nodding is how you find the errors. The second moment is more practical. Mia asks, "And where does all of this end up?" Ben's answer? It's set up to buy automatically every month, and everything goes straight into his own hardware wallet. That's all he has to deal with day to day. Many people don't dare go near this stuff. Strange words, nothing to hold in your hand. Ben set it up cleanly once, tested it with an empty wallet first. From now on, it runs on its own. That leaves the most honest answer of the whole experiment, and it's a range, not a number. Depending on how fast returns keep falling, 31 to 45 out of 100 possible scenarios reach the goal after 10 years, a good 1 in 3. Give the bet 3 more years and 3 more years of deposits. Factor in the uncertainty about returns as well, and it becomes almost 1 in 2. And this range is calculated without Ben's built-in safety rules, so it leans cautious. Whether the bet pays off, nobody knows, but you now know what it hangs on. Not the perfect moment, but time, the amount you put in, and a price nobody can predict. The tools Ben used are listed in the description. Would you take this bet? Tell us in the comments. If you're curious how your brain handles money, subscribe to the channel, and as always, this is not financial advice. It's a documentary.